Hello, welcome back. So in today's video, I'll be talking about why paying a high valuation for a stock doesn't matter sometimes. So in today's video, I'll be covering a few things. We'll be covering overpaying for compounders, interesting stocks that are falling, as well as some questions that you guys have left me in the comment section below. So when does a PE ratio not matter? A PE ratio doesn't matter when you're paying for high quality businesses because you're paying for the predictability of the stock, and for high growth stocks as well when they can grow into their valuation. So for high quality stocks, they're typically very expensive, and a lot of them, they actually trade at a very high multiple. But it's far better to buy a high quality stock than to settle for one that is of lesser quality, that is a dying business. So for example, Warren Buffett, he bought Moody's at a 28 times earnings, and he bought Coke at around a 20 times earnings. Before Coke, he actually bought all of his companies below a 15 times earnings. So you never saw him paying above a 15 times earnings for any of his stock. In fact, he bought See's Candies for, I believe, a 5 times earnings. But after he bought Coke, he started realizing the importance of business quality, and as he says, it's far better to pay a fair price for high quality business than to pay a low price for decent business. So an example is Visa. So Visa is a high quality business and it has never traded below a 30 times earnings. And this is Visa's performance despite the high multiple. It has beaten the markets over the past 10 years. And I expect it to continue doing so over the next 10, 20 years, simply because the company is incredibly predictable and it will still be able to grow at 10, 11% all these years, which is sufficient for Visa as well. So a company's moat is the company's ability to maintain its competitive advantage that are expected to help it fend off competition. So a company that is able to maintain its market share long term will give you a higher rate of return than a company in a fragmented industry. So typically when you want to hold stocks, buy stocks that are high quality in a sector where it holds a monopoly, and even if you were to pay a high multiple for it, over the long term, if you stretch your time horizon, you will still do fine. So this is what Chris Hon said about valuation. This is what he said about it in his recent interview.
And so the way we really like our long-term valuations, DCF, the most important things, and here's the thing.
So DCF, you take the cash flow and you discount it back to today.
Yeah. But here's the thing: the longer you can look out, if you've got a great company, the more value there is. Take a company we own, Moody's. Moody's,
a rating agency.
So it's been around 100 years. What do you think the average? I can ask you a question, make it fun. What do you think the average revenue growth over that 100 years has been?
I'm going to look like a total fool, but
100 years is a long time.
7%.
10.
Wow.
Yeah, so that's a very unusual number over a very long time period. And so investors have always underestimated its value, including myself. Yeah. And I bought the stock during the financial crisis at 10 times earnings, and I even bought shares Warren Buffett was selling, and he reduced his stake from 25% to, I think he's got 15%, and Berkshire. And
Are you kind of secretly pleased having bought something cheap from Warren Buffett?
Yeah, but then I sold it. I doubled my money. I went from 10 times earnings to 20, and I sold it at $100. Bought it at 50, sold it at 100. I thought I was clever, but the earnings kept compounding.
So did you buy back?
I bought it back at $150, and now it's recently $500, now $400. So it's because actually the intrinsic value compounding matters more than the stock price. If you have a great company, it will grow intrinsic value.
Absolutely.
And the multiple, here's the thing about the multiples, they matter less than the growth when you look at it over a longer period. But most investors are unwilling or unable to invest on a long-term time horizon because either they don't know what they're doing, which interestingly goes back to what they think it's risky, which goes back to what Warren Buffett was when he was asked what the definition of risk was. You know what he said? Not knowing what you're doing.
So really good nugget here is that if you buy something which is really good, it doesn't quite matter what you pay for it because it will grow.
Secondary over a long, let's just say it like this, the multiple to a point, whether you buy it at, if it's growing, it's all maths. Yep, you've got to look at the growth rate, the terminal multiple, all the multi things. But if it's increasing intrinsic value at a good rate, you will undervalue it if you look at it over a short horizon. Yep, I can be saying it like that. And if you're If you're willing to hold it for a long term and extract that intrinsic value growth, it'll be worth more to you than other people.
So what Chris Horn has said over here is that high quality companies, they'll be able to grow for a very long period of time. So as he said over here, Moody's is a company that has grown over 10% over the past 100 years, as he said. So when you have a company that is continually able to grow and grow and grow and compound, over the long term, if you stretch it, if you have to increase your terminal growth rate for your DCF calculator, it will be worth a lot more than the current multiple suggests. So in other words, what he's saying is it's okay to pay a high multiple for stock as long as the predictability is there, as long as it's able to predictably grow its free cash flow over the next few years, over the next 10, 20 years or so. Next portion, it'll be your high growth stocks. So besides your high quality stocks, high growth stocks also justify the high valuation because a company could be artificially suppressing their earnings by reinvesting into the business for even more growth. And for high growth stocks, they will typically grow into their valuation over time. So take for example a company like Amazon. In the past 5 years, Amazon has been continually suppressing their earnings. And just over the past 2 years, this company has exploded in earnings. So this year alone, it grew earnings by around 80%. And currently now, despite the stock price at near all-time highs, the stock is at its lowest valuation. So for high growth stocks, they will also justify the high PE ratio. So it's okay for you to pay a higher PE ratio as long as the growth is still around for the business. So over here, there's another metric that you can look at as well to justify the PE ratio. So this is your ROIC minus your cost of capital. Your ROIC is the return on invested capital and your cost of capital is your weighted average cost of capital. Normally is the 10-year bond yield. So when your company is able to have ROIC that is much more superior as compared to your cost of capital, the company will be able to increase the intrinsic value of the business as long as it grows. So as you can see, as long as the company has earnings growth, coupled with ROIC that is greater than the cost of capital as well, you can see a company being worth of 40 times earnings. So for example, a company like Valuation has around a 28% ROIC, and although the growth is extremely slow, it is a company that is sort of justifying its PE ratio now. In fact, Warren Buffett has been furiously buying into this stock since around a 26 times earnings. And currently now, the stock is going back to its fair value or so, around a 32 times earnings. So in summary, PE ratio is not everything. It's often better to pay for high quality and growth, assess the business qualitatively, and examine whether the company will still be able to fend off competition over the next 10 years, because this will lead to more predictable cash flows. And if you have to type it in your DCF calculator, your terminal growth rate will be a lot higher for high quality businesses that are able to fend off competition and still grow at a very high rate over the next 10, 20 years. So if a company is able to do so, then you have found a gem down there. So the companies that I'm talking about are your Visa, your MasterCard, S&P Global, Moody's. These 4 companies are the quality businesses that I can see staying here for the next 10, 20, 30 years or so. Next portion, I'll be talking about interesting stocks that I'm looking at right now. So the first stock is Copart. So Copart is an online auctioning platform that allows your insurance companies to sell their cars. So this company is trading at a 34 times earnings and year to date is down around 7%. It is near its 52-week low already, around 10% above its 52-week low. So for Copart, they provide a platform to sell wrecked cars primarily by insurance companies. So for your insurance companies, what they will do with the wrecked cars is they will try and examine how much the wrecked car cost. So if the repair cost is higher than the cost of the wrecked car itself, then they will just send it to Copart and then Copart will help to sell it for them on their platform. So they are in a duopoly with this other company called IAA in the car selling industry online, and it's quite an interesting one, but the headwinds include increased AV adoption as well as high interest rates leading to less car purchases. So when there's increased AV adoption, so this will lead to less cars for Copart to sell, and overall in the long term, if there's increased AV adoption, this could be a headwind for the business. And then the other portion is just high interest rates. So when interest rates are high, people buy less cars, and when people buy less cars, there'll be less accidents for your insurance company to coop up and sell it via Copart. So this company is an interesting one. It's a company that is expensive, of course, but it's on my watch list today. I'm tracking this one. Let's see how low this one goes. If it becomes stupidly cheap, then I may look into starting a position in this one. But currently now, I think the AV adoption risk is still quite high, so I'm still reading up on this one. Next one is Alibaba. So Alibaba in the past 5 days is down around 6% and it's currently trading at a PE ratio of around a 15 times earnings. So for Baba, it's interesting as well. So there are 2 main theses when it comes to owning Alibaba stock. So the first one is simply just your Chinese consumer recovery with stimulus checks. And then the other one is increased AI adoption in China. So if you have ever been to China, China is incredibly modernized with AI and increased cloud adoption in China as well. With Baba as the leader in the cloud computing space, it will spur the company ahead. So it's a company trading at a cheap valuation as well, around a 15 times earnings. Although I would like to have a cheaper discount for me to enter into this one. I'll likely initiate a small position, maybe around a 2% or so. If it reaches around $110 to $100, that'll be where I'll be comfortable adding into this one. Next stock is LVMH. So LVMH is a stock that is now around 16% year to date, currently trading at a 19 times earnings with a dividend yield of around 2.6%. So for LVMH, I'm patiently waiting for this stock. The company is extremely high quality, but the problem with the business is it is stunting its own growth. So there's no way for the company to grow beyond 10% without diluting the brand, and I don't believe that the management will be willing to dilute their own brand. So for LVMH, I'll be waiting for the stock to drop to around $90 a share when it's trading around a 16 times earnings. That'll be when I'll be adding into this one. At $90, there'll be a decent margin of safety, and with a 3% dividend yield at that price, and a 5 to 7% revenue growth for this company, it's a safe 10% without multiple expansion. So likely at around $90, I can see market beating returns, but currently now at $109, I still don't see much of an upside in this stock. Next one is Amazon. So Amazon is a company that is still trading at around 33 times earnings. And for me, I think Amazon deserves a much higher multiple. Currently, it's down 6% year to date, and Amazon is one of the highest quality businesses out there. It's currently trading at around a fair value, but if you're willing to hold this company, as Chris Holmes said, for the next 10-20 years or so, then I think Amazon is a high quality business that will give you alpha above the markets over the long term. Next one is Amazon's competitor, Pinduoduo. So there's a comment over here that says, what do you think about Nextera and Pinduoduo? So I'll be talking about Pinduoduo over here. Pinduoduo is a company that missed earnings as well as revenue. So this company is now around 15% in the past 5 days and currently now is trading at a 9 times earnings. So if you were to look into that earnings itself, the earnings were terrible. So they increased revenues by 10%, but the operating profit dropped by around 38%. Your net income dropped by around 47%, and overall the core business itself looks like it's dying. So for Pinduoduo, the problem with the company is that the company is reliant on selling cheap goods. Meaning to say, consumers only come to the platform because there are cheap goods there. And for me, I don't think that is a strong enough competitive advantage when it comes to owning a company like Pinduoduo, especially in a extremely competitive space, which is your online retail business. So there are other competitors in the space as well. We have AliExpress, which belongs to Alibaba. We have Amazon as well. Amazon is a juggernaut in this space, and I don't see them being displaced because of the customer loyalty that they have. But for Pinduoduo, I don't think they have that customer loyalty. And besides, retail is a bad business for you to invest in. For Amazon, it's a different story because Amazon is using the Amazon.com platform as a funnel for all their different services. But for Pinduoduo, they are simply just a retail business, and for me, I don't think retail is a good industry for you to invest in, and that's why I think Pinduoduo today, although it's a cheap stock, I would avoid it at this price. Last portion, I'll be talking about some questions that you guys have left me in the comment section. So the first one over here, it says, hi bro, what's your thoughts on Coreweaves, especially after today's run-up? So a few things. Number one, try and dissociate the stock price from the actual fundamentals itself. You're buying a stock because of its fundamentals, not because of its stock price. Meaning to say, when the stock price goes up, you shouldn't be excited into buying the stock. In fact, you should be doing the opposite. You should be excited when the stock price goes down. So for Coreweaves, I think it's a highly speculative company. So if you don't know what Coreweaves did before they IPO, basically what they did was they sold a portion of their company to Nvidia, and then they used their money to buy Nvidia chips. And then they used the Nvidia chips as collateral to get loans. And it was sort of like a Ponzi scheme that Nvidia and Coreweaves did together to attract retail money. So for Coreweaves, I think it's a speculative company, and for me, I think it's a company that is still growing rapidly, of course, with this AI boom and all that. But it's simply just too speculative for me, and I wouldn't buy it simply because the stock price is up. So Coreweaves is an avoid for me. Next one, I came across the stock IDM in consumer staples. I would like your input on it if possible. Thank you. So ADM is a company that sells food products. It's a competitor to a company in Singapore called Wilmer. So for me, I think ADM versus Wilmer. Wilmer is currently the safer bet because in Singapore, you don't have your dividend withholding tax. Your dividend taxes are 0. So you can get a 5% yield from Wilmer and own a stock that is of similar quality to ADM. So both of them, they sell commoditized products, so there's not much of a pricing power over there. The only way that I can see these two companies working is for your food prices to come back again and for inflation to basically go up again. And currently now we're in a slowdown in terms of inflation. And I also don't like holding on to commodity stocks unless they are very, very undervalued. Wilmer is a company that is quite decently undervalued, so I've been looking into that one. But currently now, because of the debt itself, I don't think I'll be investing into that one. So ADM, I think a better alternative is just to invest in Wilmer. Wilmer will give you a 5% dividend yield, and it's a safe 7% every single year if you're to hold on to that one. Last comment over here, it says, semicon industry seems to be doing very well. Can you share your thoughts on AVGO? So AVGO, I'm not too sure what the business is, but the company is growing quite rapidly. Fundamentally, it is sound. And I know of people working in the semicon industry that is holding on to this stock with extremely high conviction. But for me, I don't understand the business enough, and it is trading at a high valuation as well. I think if you were to play this AI bet, the most predictable one is ASML. ASML is a company that sells lithography machines, and it has a 100% market share in the EUV space, and every single AI company will have to pass through ASML. So for me, I'm not too sure what AVGO does. I have to read into that one, but for now, it's a stock that's trading at a high valuation, and for me, it's an avoid at that price. I hope you guys have found this one useful and invest safe.